Welcome to The Explainer. So, if you've been keeping an eye on the markets, you've probably felt it, this sort of quiet, steady optimism in the air. But here's the thing. Is that feeling actually based on solid ground, or could it be some kind of trap? That is the big question we are tackling today, and trust me, we're going to dig deep.
At first glance, things look pretty calm, almost sleepy. During the Thanksgiving holiday week in the US, which is usually pretty quiet, futures on the big indexes like the S&P 500 and the Nasdaq saw these kinds of small, steady gains. We're not talking about huge, wild swings, just this gentle, almost reassuring upward nudge.
And this gentle climb really tells the mainstream story right now, that the market's in a good spot, floating on a wave of positive feeling. The general vibe is that, hey, maybe things are finally heading in the right direction.
But, of course, that's just the surface story. So let's start peeling back the layers and really look at what's driving this rally. We have to ask ourselves, are there some major risks hiding in plain sight that all this good feeling is kind of covering up?
Okay, so let's start with the official story. What's the narrative that's fueling all this optimism in the first place?
Well, this optimistic narrative is really being pushed by a couple of key things. First, and this is a big one, there's a super strong belief that the Federal Reserve is about to cut interest rates, which would make money cheaper to borrow. Second, there's just a general feeling of recovery, especially around tech and AI. And finally, all eyes are on key economic data that's coming out, like the PCE index, to see if it backs up this positive trend.
But here's what's so crucial to understand. This optimism, it isn't just some vague feeling in the air. No, it's almost entirely pinned on one single massive expectation. And check this out, because this is where it gets really interesting. Look at the speed of this shift. According to the CME FedWatch tool, just 1 week ago, the market was pricing in only about a 32% chance of a rate cut. Today, that number has absolutely skyrocketed to nearly 83%. I mean, wow, that is a gigantic leap of faith in a very, very short amount of time.
And right here, this is exactly where we need to pump the brakes and start asking some tougher questions. Is it really a smart strategy to bet the farm on one single outcome? Or is that actually an incredibly fragile way to think?
Historically, just the idea of cheaper money, just the expectation of it, acts like a shot of adrenaline for the stock market. It sends prices soaring. But this is so dangerous. It can create these massive bubbles that are totally disconnected from reality. And this is a pattern we saw play out with just disastrous results, first with the dot-com bust in 2000, and then again with the huge financial crisis in 2008.
And this brings us to another huge risk that's on the table right now. The source material talks about holiday-thinned trade. What does that mean? It means not a lot of people are actually buying and selling, and this creates the perfect playground for what they call market whales. These are investors with just massive amounts of capital. In a quiet market, they can make moves that create these artificial price swings and basically mislead everybody else. Their actions have a giant, outsized impact. So what we're left with are two completely different stories. Is the hope for a rate cut a sign of a healthy, strong economy? Or is it just a psychological game being used to pump up a bubble, setting the whole market up for a fall where the insiders can cash out?
Now, this isn't the first time we've seen this kind of thing play out, not by a long shot. So let's take a look at history, because this whole pattern of optimism, cheap money, and bubbles, well, it's a theme that just keeps coming back.
I mean, time and time again, whether you're looking at the dot-com bubble or the 2008 housing crisis, we see this exact same four-step cycle. It always starts with an expectation. That leads to a flood of cheap money. That cheap money then forms a bubble. And when that bubble inevitably pops, you get a crash, which leads to bailouts and a massive transfer of wealth.
So, the crucial question, the one we all have to ask ourselves, is whether today's perfect storm of rate cut hopes and AI hype is just the beginning of that exact same cycle all over again.
So, if history is our guide here, where could we possibly be heading? The skeptical analysts we're looking at see 4 potential scenarios that could unfold over, say, the next 3 to 6 months.
All right, let's just quickly run through these 4 possibilities. On one hand, you could have what's called the growth stock harvest, where the rally just keeps going, led by tech and AI. The risk there? Price manipulation in a low-volume market. Then there's the asset bubble scenario, where all this cheap money inflates a brand new bubble that could be popped by some sudden shock. It gets a bit more serious with a potential flash crash, where low trading volume and some bad news could trigger a massive sell-off. And then there's the worst-case scenario, the bailout game, where a crash happens and the big institutions get bailed out yet again.
Okay, so with all of these possibilities on the table, how can you stay informed and prepared? Let's talk about the warning signs to watch for and some practical steps you might consider, all based on the source material.
A skeptical analyst would tell you to watch for 4 key signals. First, super low trading volume, because that can lead to wild swings. Second, big market moves based on what seems like pretty minor news. Third, and this one is kind of ironic, surprisingly strong economic data. Now, why is that a red flag? Because good news could convince the Fed not to cut rates, which would pull the rug out from under this whole optimistic rally. And finally, you got to keep an eye out for insiders selling off their stock in huge numbers.
Now look, this is absolutely not financial advice, but the source does lay out a pretty common sense framework for caution. It suggests staying liquid, holding some cash so you're ready for whatever happens. It recommends diversifying so you're not putting all your eggs in one basket. And it really hammers home the importance of doing your own homework, following the economic data, and most importantly, learning to separate the real story from all the market hype.
And that brings us right back to the central question. As you watch the markets, you've got to ask yourself, how much of this rally is actually built on a solid foundation of economic reality, and how much of it is just floating on a powerful wave of pure emotion and expectation? The answer to that question could really make all the difference. Thanks for watching The Explainer.